Welcome back, my loves. Welcome back, welcome back. This is week 5 of Stock Market Foundations. Tonight, we're going beneath the surface of what most people think when they hear the word stocks. Because if you're still thinking it's just about buy low and sell high, you're missing the part that really matters. And this class is about ownership and valuation, movement, and how all of that ties into you making smart, confident investment decisions, So let's just go ahead and get into it. Today we're going to talk the objectives is to have a clear understanding of what it means to own a stock, the difference between a stock price and the company value. Oh, baby, that is so important. There is a difference between the stock price and the company value. Why a stock price moves or what makes it moves even when nothing changes at the company, and how tools like dividends and stock splits work in real life. And by the end of the class, it is my goal that you won't just know what a stock is, but you'll know how to interpret what it's doing and whether it belongs in your portfolio or not. But we have to start with the heart of it. And when you buy a stock, you're not just buying a ticker symbol or chasing a trend. You're buying equity. That's a legal word for ownership, equity. If you own one share of Apple, you technically own one small slice of Apple Incorporated. And that's a heavy sentence right there. I feel like that hits harder when I say, oh, yeah, I own Apple. And oh, I own a piece of Apple Incorporated. It hit a little harder to me. So that's going to include their profits, liabilities, real estate, their patents, their debt, everything, all of it. You are on the cap table, meaning that you have a seat at the ownership table, no matter how small it is. And that's major. You got a seat at the table. Now, owning stocks, or it gives you rights. So you might have the right to vote on major company decisions like board elections or mergers, and you might be eligible to receive dividends, which is just payments made out of the company's profits, like a little bonus. Thank you for holding us. And then you have the right to the capital gains, which just means that when the company grows and your stock appreciates, you get to keep that growth. That's why it's important to think of yourself not just as a trader or investor, but as an owner. Because would you buy a rundown restaurant just because it's cheap? Or would you want to know what it's serving, who's managing it, and whether it's actually making money? It's the same thing with stocks. Now, I want to address a usually like a something that I don't feel like people really ask much or dive into much, which is how do companies go public in the first place? And that's an IPO, which is an initial public offering. And that's what it stands for. But it's, I'm sorry. The IPOs are financed and facilitated with investment banks. So we're gonna have Chase, well, JP Morgan, Morgan Stanley, Goldman Sachs, them big names, right? So the banks are acting as underwriters. Just think of them like a high level broker who helps the company price, package, and sell its shares to the public. Now it's very basic steps, but I find it fascinating because I do plan and I'm working my little booty off to IPO Wall Street Boom Black one day in the future. But the first thing is the company has to file with the SEC to register its shares. And then the investment bank set the initial price and number of shares they believe the market will support. So the investment banks is setting that initial price. They do their little digging, their little calculations with the finances and everything, and they get to a number. Then after that, the institutional investors get first dibs during, they call it the road show, when they take in their IPO on the road. Like, hey, we seeing Klarna go through their road show right now. And it's quite fascinating actually, because they have companies like Affirm and Square shaking in their boots for when they go public. But an institutional investor, that's the mutual funds, pension funds, hedge funds, just all those, right? And then the last step is that once those shares are sold to early buyers, the ones who were able to get the first dibs on the roadshow, the stock initially hits the exchange market, like whether it's NASDAQ or the New York Stock Exchange, whatever, and then retail investors like us can buy it. It sounds simple, which, yeah, a lot of paperwork, but it's fairly simple. So it's not just about going public, it's a strategic fundraising. And it is literally a fundraising event where ownership is sold to raise capital, to build legitimacy behind the brand, and provide liquidity to the early investors. So now that leads me into who decides how many shares a company starts with. Now, before going public, a company works with the underwriters and legal teams to decide how many total shares will exist, which is the authorized shares. Not every public company has the same amount of shares. It depends. How many will be, they also decide how many will be sold to the public, which is going to be the outstanding shares. Authorized shares is how many they have, period. So we'll say they're authorized to have 1 billion shares on the market. But then the amount of shares that they're going to sell to the public will say is 200 million. That's their outstanding shares. And then they also decide how many will be held by the insiders or reserved for employee stock options, which we love a company that gives their employees stock options because thanks for caring about our future even a little bit, you know? Now, this total supply is going to help determine the share price. That's where the share price comes from. A higher number of shares may lead to a lower price per share and vice versa, but it just depends on the valuation they want to achieve. Now, can they issue more shares later? Yeah. A company can file a secondary offering or increase its authorized shares through a shareholder vote, which is us, right, in the board. But issuing more shares is just going to dilute ownership. So it's like adding water to some apple juice. You just, you cutting down on that sugar. So your slice of the pie is going to shrink unless you buy more. So we measure how much a company is worth, not by the stock price alone, not by the stock price alone. The real measurement is in the market capitalization, or I'm just going to be saying market cap from here on. And we determine the market cap by multiplying the number of outstanding shares by the current share price. So if Apple has 100 million shares and the stock is trading at $50, that means that the market cap is 50 billion, right? 100 million times. Yeah, it's 50 billion. So that's the total value the market places on that company at that moment. And look, this is why you cannot judge a book by its cover or a stock by price alone, because a $3 stock could belong to a tiny unproven company, but a $500 stock could belong to a company with a $1 trillion market cap. And the price per share is just a slice. It didn't really tell you the size of the pie. So don't ever, we got to look at companies like American Airlines. They are not a little bitty company just because that share price is down there, you know? So the next time someone says Amazon is too expensive, you can just say expensive compared to what? What is it expensive compared to what? Because it's in here on this doing its own thing. Okay. So let me say it again. Because it truly matters. Price does not equal value. Has nothing to do with each other. You're comparing apples and oranges. All right. Just because a stock is priced at $10 doesn't mean it's cheap. And just because it's $300 don't mean it's expensive. The value of the company is based on its ability to generate profits and to be able to grow over time and shoot to remain competitive within its sector, or even, well, really its industry within its specific niche. And that's why we want to use things like market cap and paying attention to the earnings reports and the revenue growth and to assess its true value, not just the sticker price. So I guess I want to say, like, you wouldn't go to a car lot. Now I'm thinking because I'm having to buy a new car, right? But you wouldn't go to a car lot and just judge every car by the price alone and the color and how pretty it is, right? So we don't want to do that with stocks either. We want to understand what's going on under the hood. So if the stock price doesn't always reflect value, what makes it move? If you were wondering that, great question. Many things. We're going to have internal and external factors, but it's driven by expectations and reactions. human behavior. We're going to have the earnings report. Like I was saying, we're going to have the earnings reports, public companies, which is just public companies reporting their financial performance. We know every quarter. If they beat expectations, the stock may rise. If they disappoint, even if they still make profit, the stock might drop. We're also going to see company news, like a CEO resigning, or one of my favorite examples is Bed Bath and Beyond. The CFO, I believe, it was about 3 years ago now. I believe he was the CFO. Yeah, he was. He was caught stealing, cooking the books, doing whatever he was doing. And when he was called out on it and fired, he ended up, God rest his soul, but he ended up committing suicide. That's the type of stuff that I'm going to pay attention to. And where's Bed Bath and Beyond at now? Barely anywhere. All right. So now a new product that's also going to get it. Someone in here was looking at Levi's, or was it in stock analysis, for their company profile. Love it. We see what Beyonce done did to that stock. Love it. Layoffs for sure, because these all influence how investors feel about the company's future. Economic changes for sure. Y'all know we care about that economic calendar. So interest rate hikes, inflation data, unemployment numbers, these all affect how investors feel about risk, growth, and spending. Now, there's also going to be the rumors and the sentiment, okay? Because sometimes stocks move based on vibes, unfortunately. Sometimes them suckers be moving on vibes. Like if it's a rumor of an acquisition, somebody gets to tweeting, or it's a surge in Reddit post, anything like that. We've seen it with what's his name? Kitty, Big Kitty with GameStop. No, God, that's not it. What is it? Roaring Kitty. There we go. We seen that with them. And then we can't forget the role of the algorithms either, because most large institutions are using trading bots that react to these headlines and volume spikes or price thresholds pretty instantly. So that's part of why the market can feel so jumpy sometimes. But I want to talk about some real world examples that we have. Um, Apple, I think, is a classic case of internal momentum. You just can't get more classic than Apple. I think that's the perfect company to go in and study anything. You want to learn how to research a company, start with Apple. Start with Apple, and then JP Morgan and Pfizer. Yeah, those three companies. You want to learn how to research a company really well, start with those three. But however, back to Apple. Every time they drop a new iPhone or they beat expectations on revenue, what typically happens to the stock? Y'all let me know in the chat. What typically happens to Apple when they beat earnings? Ooh, we see a rally. On the other hand, Boeing, okay, they've had some internal drama when say with safety issues with those 737 MAX planes. Okay, what happened to Boeing stock? Even before the government got involved, it dropped. It dropped. Amen. So now we want to look at okay. So now we want to, she said it went to, oh, not it went to HELL. That it did. That it did. But now let's look at some external forces. So we're going to have airline stocks like Delta, American, United, Airline, all of those. When is a time in recent history when those plummeted? Exactly, COVID. That was not due to, did the drop in those prices make American Airline, well, let's go with United Airlines, the pandemic, amen. Did the drop in United Airlines stock price have anything to do with the company internally? No, the companies didn't mess up. It wasn't a sell. We only sell when a good company turns bad with no hope of coming back. Let me say that again. We only sell a good company if it goes bad with no hope of coming back. Well, let me, mm-mm. Third time's a charm. We only sell a good company if it goes bad and gives us no forward guidance of how it can come back. All right. United Airlines, that went on them. It was a global event, shut down travel. That's an external macro shock. And they came back. They did very well. I suggest y'all check out Jets. JETS. That's what we traded in the play I called out in the family chat. Was that Friday? Now let's take some tech stocks like Nvidia or Meta, because they had some huge runs from the end of 2022 into 2024, just driven by what? There's one big industry that made tech just go crazy. What was that? AI. AI. The second a company puts out a headline that they're doing something with AI, just, whew, there go that macro. Now we're going into macro sentiment. It wasn't about earnings. Yeah, the company was doing good, but it was like, ooh, innovation. Ooh. So now let's look at company. No, we'll go here. Let's look at company news. So a good earnings report, a new CEO. Yeah. Is anyone in here in stock analysis? Y'all already know what CEO I'm in love with. Who remembers my favorite CEO? If you don't, I have a picture that I can show you again. Brian Nichols, you know it. I love him down. Okay, he can make a stock price go up. Look at Starbucks. Or a surprise acquisition. Look at Pepsi when they acquired Poppy. Woo! $1 billion deal. The investor sentiment was at an all-time high. And these things can push your stock price up. A major data breach or a regulatory fine or a product recall can push it down. So I want to pause here and I want to talk about Johnson and Johnson. What product was known for killing folk with Johnson and Johnson? What product did they have that we just did not hear good things about? It was like, oh my gosh, when are they going to take that off the shelves? The talk powder, the baby powder, amen. Now, guess what Johnson and Johnson did? And I'm going to say this in a very general, like wrap it up with a bow type of way. Johnson and Johnson said, well, we kind of want to get over here into these vaccinations, but it's hard to step into the vaccination lane like real heavy with it, and into the medical space and whatnot. If we have a product that's killing babies, now instead of taking it off the shelves and losing one of our oldest and most valued products, we're going to create a separate entity called Kenvue, Kenvue. Kenvue, and the ticker is KVUE on the stock market. I don't think it's in the S&P 500, but you can still buy the Johnson and Johnson baby powder underneath Kenvue brand. Fascinating. But if you look it up, Johnson and Johnson can legally and somewhat consciously free say, oh no, we don't sell us talk. No, 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 no. Come on back over here and invest in us. Because when that news came out, phew, because what was that, like 20? That was post-pandemic, wasn't it? Yeah, that was post-pandemic. Y'all should go look at the charts on that. Um, so it's not always about what happened. It's about how investors interpret what the event means for the company's future performance. Yeah, I'm still not back invested in Johnson and Johnson. Absolutely not. I went on and moved it over to Procter and Gamble. I was only in J&J for the dividends anyway, but that's neither here nor there. But let's zoom out to external forces a little bit. So the stock market isn't isolated. It reacts to the overall economy. It is not a direct representation of the economy. but it does react to the overall economy. So when the Fed raises interest rates, borrowing money becomes more expensive, which then slows down business growth. If business growth slows down, what do you think happens to the stock price? It drops. When inflation is high, people spend less. The costs rise and profit margins are going to get squeezed. That's bad for most companies, especially if they're consumer-driven companies. What is a consumer-driven company that you can think of that is being heavily affected right now by inflation and rising costs? You can't say Walmart. What else we got? Okay, you can't say any you can't say any retail store. What else we have? Not they put Target in the chat. You can't say Walmart, Target, Costco, nothing like that. What y'all got? But logistics, what? Who's under logistics? Cosmetics, ships, trucks, Pepsi. I would say for sure. For sure, for sure. Because Pepsi is definitely, y'all know what it took me into a movie I was about 2 weeks ago old to realize a buy three, get one deal. It's really not a deal anymore because they upped the prices. So I'm still paying for four. Y'all just made it sound good that I'm getting one of these for free, but the price increase, baby, I'm still paying for four of them. Them 3 for 1 signs be getting me, boy. Buy three, get. I love me a good BOGO until I realized, oh, inflation. Got it. Sounds good, right? Sounds good. So unemployment is another indicator. Jesus, unemployment. If folk are losing jobs, demand slows. If demand slows, earnings drop. If earnings drop, companies raise prices. When companies raise prices, consumers stop spending as much, which makes companies become even more cautious. It's a domino effect, a nasty domino effect. And then of course we have global events like the wars. It's honestly a shame that I just caught that I said that in a plural uh tense. The wars, because where we got the Middle East, the in European, but pandemics and shoot, oil supply shocks for sure can shift the entire market in matters, like in just a matter of hours. You have to stay aware of the macro picture if you want to understand short-term price moves. Ukraine, period. You know, we want to, we, you, I don't care. I don't care. He my biggest op. I love him down. You have got to understand the macro picture. You have to. Because, like, let's keep it real. A lot of movement in the market isn't math, it's mood. Let me say that again. A lot of movement in the market isn't math, it's mood. Investor sentiment is the collective feeling of optimism or fear in the market. Like when people feel hopeful, they buy. And when they panic, they sell. I've been there before. I've definitely been there before. 2000, let me backtrack. Let's see, I got out of the Army in 2018. Nope, not out. I retired from the Army 2018. So it would have been 2019. Because I know I sold before March 2020. It was when we first kind of started hearing stuff. Y'all, it was a tech company. Can you guess what I sold? I got nervous. I got scared. It was like pandemic. Oh my gosh, I just got out of the army. Now I'm only getting paid once a month, not twice a month. What are we gonna do? I'll give you a clue. It was the biggest tech company in the world. The biggest tech company in the world. I had about $4,000 worth of equity. worth of shares in Apple and sold it. When price dropped about 7% and sold it. Oh, baby, that still gets to me when I think about it to this day. That still gets to me. You know, I don't do that anymore. You know better, you do better. It took that one drop for me to see how it came back, for me to know, okay, I'm not going to invest in companies that I'll even think about selling. Absolutely the frick not. Won't even do it. Mm-mm. Um, now where am I at in my notes? When they panic, they sell, and those swings in emotion can move stocks more than an earnings report ever could. I know, I know, y'all. I know, y'all. 2000, so it would have been, I saw before, I know I was already out before the market bounced or before it like really, really dropped in March. Cause I remember being like, yep, yep, I was right. And then came April and I was like, oh my God. Mhm. Hey! All right. So some common emotional triggers that we have is fear. I'm gonna move past that. Now I just told you a story. Greed, which is where people pile into a rally expecting endless gains. That's what we're seeing with Palantir right now. Is greed, straight up greed. Everybody running into it the last or let's go back to Nvidia. Do y'all know anyone who was trying to buy Nvidia when it was worth $900 last year? Whether it was you, you ain't got to tell on yourself. Whether it was you or you just know of someone. Anybody know like anyone who was trying to looking to buy Nvidia when it was, I'll say five, six, $700, and it was like, oh my gosh, this is gonna keep climbing. It's gonna get to 1,000. I know quite a few. I know quite a few who wanted to start buying Nvidia at 400, 500, 600. And it was like, what are you doing? Wow. Weird. There's also going to be FOMO, which is the fear of missing out on a stock that's taken off. And then herd mentality, which is crowd psychology, really, just following the crowd without doing your own research, your own due diligence. And there is a tool where we can measure sentiment through tools like the VIX, which we call the fear index, or by monitoring how the news and social media are framing market events. I pay attention to the wording of headlines. That's definitely pay attention to the wording of headlines. So smart investors learn to watch sentiment, but not get swept up on it. We understand we still have to go back to the technicals, but let's talk mechanics. Let's talk about the mechanics of a stock and different things that it can do. A stock split is my fave. This is my fave thing that happens in the market. I don't know if it's a stock split or a reverse stock. Let's get into it though. Now, a stock split is when a company decides to divide each share into smaller pieces. So a 2-for-1 split means if you had 100 shares that were priced at $200, after the split, you now have 200 shares priced at $100. Okay. Ooh. Your ownership percentage hasn't changed. The company is still worth the same, but now the stock may appear more affordable, especially to newer investors. Herd mentality. Herd mentality. A company like Nvidia was going to do a stock split. It was going to do a stock split. It needs us to invest in it so that it can continue to grow at the rate that they're growing. It needs us to be excited to want to buy in it. They had to do a stock split. I ain't gonna say had to, right? Because let's look at AutoZone. But AutoZone, I feel like just looks at us like, I mean, buy us if you can. If you can't, oh well. Because it's the institutions that are buying us up anyway. That's who needs us, right? Let's see. I have a real example. We're going to go back to Apple. It split its stock a 4-for-1. Now, remember the dates I told y'all, okay? From when I sold. I'm going to go ahead and we'll just say sometime January to February 2020 is when I sold my Apple shares. Maybe even started like selling them in December. They did a 4-for-1 split in August 2020. I just, I just, I'm trying to get through this. I want to cry every time I think about it because my gosh. But each $500 share became 4 shares at $125. It made the stock more accessible and it built even more momentum with retail investors. Like, I, you know. Now, reverse split is the opposites. It's when a company might combine shares to raise the price per share. And most of the time, they're doing this to avoid being delisted from an exchange or to clean up its appearance. Okay. A reverse split is a cleanup act. And a good example of that is GE, General Electric. In 2021, they did a 1-for-8 reverse split, which is crazy. So if you had 8 shares at $12.50, you ended up with 1 share at $100. The value didn't change, but the optics did. Institutions are more likely to take a company seriously when its stock doesn't look like a penny stock. That makes sense? With those examples with Apple and General Electric, with a stock split and reverse split. Love, 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 love. Good. Now I want to wrap this up with one of the most slept on wealth builders in the market. This is passive. This is passiveness, passivity, if one of those is a word. If not, it is now. A dividend is just a portion of the company's profit that's paid out to shareholders. Not all companies offer them. Between a growth and a value company, which one would offer dividends? We got one for value. I'm coming back to you, Alexis. What else we got? We got one for value. But we got, even if we, you could put a V or a G, whichever one. Value, value. Okay, period. Yes, y'all are right. I just want to make sure we all here. We all good to go. Period. Yes. Now, before I move on, let me go back because that was actually, I mean, not actually, but that is a really good question, Alexis. I love that. And yeah, they have access to deep research and they usually have they're gonna have like an entire analyst team and subscriptions to these high tier data platforms like Trading Ticks. Institutions absolutely use Trading Ticks, trust me. And let's be honest, they rub in elbows and they have direct access to the company leadership during the earnings calls and just at dinner, meeting up or whatever. But the thing is, optics still matter because a stock price sitting at $3 or $4 can signal risk or distress to institutional investors, regardless of the fundamentals. Billions is a very good example of that. I love that show. Love, love, love that show. Billions is on Showtime. And I'm known to give out my password to apps and things like that. So if you ever need it, I don't know. It's ever since Netflix did the thing where they took the password sharing away. Now I just feel like I'm real heavy on anybody want my password on the other apps. Okay. Um, Now, mind you, though, they still do have compliance rules and like perception rules, there's literally perception rules and portfolio rules and all of that. And some mutual funds or the pension funds have guidelines that won't even let them hold stocks that are under $10. Let's keep that in mind. Even if the research is solid, the optics could stop them from touching it. But, hmm, yeah, I mean, just goes right back to the reverse split though, of why it can be so strategic or why it is so strategic, because it helps the stock look more stable on the surface, even if nothing has really changed underneath. You're just putting lipstick on a pig, I guess, dressing the part for the interview. Did that make sense? Okay, period, period, period. Okay, period. Of course. I love when y'all ask questions. So yes, value company, mature company, absolutely. We can take our dividend as cash. Listen very closely. That is what most retirees prefer. Retirees prefer to take the dividend as cash. Or you can automatically reinvest it through a DRIP, which is just a dividend reinvestment plan. And that means your dividends buy you more shares, and those shares pay more dividends next time. It's the magic of compounding, the magic of compound investing. Not every brokerage offers drip though, I'm sorry. But the major ones do. Fidelity, Schwab, uh, Vanguard, Robin, does Robin, I believe Robin Hood does. That, yeah, Robin Hood does. Yeah, because we're doing it with our dividend portfolio. Webull, okay, cool, cool, cool. SoFi does. I absolutely love that SoFi does. And you usually have to turn it on in your settings. They did, but they're late. Yeah, right. That's what I'm saying. Yeah, I know Robinhood does because I turned it on there. Yeah. So if you're a long-term investor, drip is one of the easiest ways to just quietly grow your position over time. It's no extra work. It's no extra cost. Just set it up, babes. Set it up. Set it up. So this is our full foundation for understanding what a stock really, really, really is. Well, we went through that. So understanding what a stock really, really, really is. Not just in theory, but like its function, the value, the movement, the potential that it has and everything. And, now we know how to read it beyond the price. Because if we can interpret the market cap, earnings, and headlines, dangerous. You're going to know what it means to become an owner, not just a spectator. You feel me? This is how we invest with purpose and not hype. Everything that we went over today, if a company hasn't done this, if it don't go match my checklist on this, check off whatever. If it don't do what it need to do as I'm going through these categories, yeah, moving on. Moving on. Can you mention again what you were saying about headlines? You said pay attention to how it's written. What's that really mean? To how headlines are written. So, yes, I'm going to pause this and pull up a headline now. I came to Yahoo Finance and clicked on news, the news tab, and then click stock market. And the first one what the heck? Push the back button. That I saw that fascinated me was Palantir sales forecast falls short of Wall Street's hopes. When we read that as an investor, whether you're invested in it or not, hypothetically, we all are. When you read that headline, are you thinking, oh my God, Jesus, what happened? Palantir fell. Like, what's your first thoughts? It's like, eh, or, oof, which one? What are your first thoughts? We got, it would make you, well, no, but Tracy's first thoughts was to buy more. Okay. Eddie's, was it shocking? Okay. What about you, Alexis? Your first thought is to do some research. Okay. Foreshadowing. Your thought would be, is this a foreshadowing? A foreshadowing of, I was wondering if someone was going to say that, like a foreshadowing of other tech companies dropping to buy more. Well, because we in the right home, of course. Now, would most retail traders think that? Or retail investors think that? Or would they get scared and let that fear kick in when all we talking about is recessions and boom, 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 right? Palantir Technologies dropped more than 8% in late trading Monday after its results failed to live up to investors' loftiest expectations for a company whose stock has led the S&P 500 in gains this year. Well, that was shady opener. That was a shady opener. Shady. Shady boots. Shady. Loftiest. Okay, that's the key word. The company described rising demand for artificial intelligence software as a ravenous whirlwind and bumped its 2025 revenue forecast to about 3.9 billion from about 3.75 billion. That represents growth of 36% from a year ago. But they dropped 8% on the earnings report. Hmm. Palantir is best known for its work with U.S. military and intelligence agencies while also selling its data analysis tools to governments and commercial customers. The company has recently ridden a wave of AI enthusiasm, sending its stock soaring and worrying some investors. Recently, shares were trading at more than 200 times estimated earnings, making it the priciest in the NASDAQ 100 index by this metric. Nachi was 200 times overvaluated or overvalued. The company's growth was strong in the US, but tepid enthusiasm in the rest of the world, which constitutes less than one-third of Palantir's business, concerns some analysts. Even with all the good news, it just wasn't enough to sustain the valuation going forward. There wasn't any clarity around any new drivers of business. Okay, cool. What else y'all got going on, Palantir? It was cute. Got it. We done sold it up to where we or bought it up to where we expected. Now what y'all got? In his letter to the shareholders, the CEO said that the company's growth has outpaced expectations. This is a level of surging and ferocious growth that would be spectacular for a company 10th of our size. I listened to that and I felt like what he said was, hey, we just grew real crazy. Y'all just saw how crazy we grew in a year and a half. A company that was 10 times as large as us wouldn't even be able to keep up with the demand we've been able to keep up. Give us a break. At this scale, however, our ascent is, we believe, unparalleled. The company's revenue for the quarter jumped 39% to 884 million, exceeding analysts' average estimate of 863 million, according to data compiled by Bloomberg. Profit excluding some items were 13 cents a share in lines with estimates. In the US, so blah, blah, blah. As we're reading this article, as an investor, forget the headline, but just reading this, does this make you want to invest in Palantir and say, oh, they're growing, or does it make you want to sit it out on Palantir and wait for them to have some forward guidance or to see some new forward guidance? Which one? Palantir is still strong. I want to buy. It's still a buy for me. Right. Buy. 36% growth in a year? Got it. But look how the headlines tried to. Palantir sales forecast fall short of Wall Street's hopes. Baby, my hopes and dreams, not it's okay. It's okay. Thanks for the little pushback. Now I can get me another lead. Thanks. You know? Sales to commercial customers grew 71% or grew 71% in the quarter. Sales to the US government grew 45%. And they got new deals. This is very much so still a buy. Them headlines just be trying to get you. Now let's go back and let's look at something for the tariffs, which, mind you, well, let's read a headline first. Trump tariffs live updates. No plans for Trump and Xi, I believe. Talks. Ackman floats China pause. I want to read. Oh, is this just like the main one it has? Oh, okay. It's live updates. Let's scroll down some. So this was Sunday. What did Microsoft do today? Let's look at the chart first. I mean, we had like a stagnant-ish market, but let's look at Microsoft's price on the hourly time frame. A bit of a push up, but then nearly gave it all back. These last seven candles is today. So a bit of a push up. Rejected Friday's highs and nearly gave back today's price action. So like the first hour of trading. Okay. So let's go to the headline. The headline says Microsoft raises Xbox console prices, games to start at $80. Record and stop real quick.